Hi everyone, this is part 9 of my Rivian deep dive. In part 8 we wrapped up with discussing the optimism built into the gross margin assumption of the R2 platform launch and ramp up. On this slide I want to discuss a somewhat a slightly complicated point about Rivian's guidance and in some what I consider irreconcilable differences. So, big picture. So there is the one of the two big segments is software and services, or short SNS. And SNS has two components, services and other, and the VW JV. Management told us to expect for the whole segment, SNS, a 30% gross margin. But here's the problem. Management also told us that they expect VW JV revenue to be pure profit. Pure profit means 100% gross profit margin. On this chart, you see a much lower margin. It's ramping up quite a bit, but it's much lower than 100%. It's just here, like in the 40%, and then going all to almost 70% by the time the revenue is paid out, almost paid out. So the reason why I cannot use a 100% gross margin is the following. The services and other component is a very low margin type of business, but it is profitable. We can work out that the margin they brought in recently was, in fact, already in, it's not shown in this chart, 4.7% in 4Q 2023. And the fleet, which is driving that segment and other things, has been growing since then. So we know it's profitable, but not deeply loss-making. And the reason why this observation matters is the following. If you set the VW JV revenue at a 100% gross margin and run a modest profitability for the services and other segment, the numbers don't add up. It's way more than 30%. So something has to give. So you have the following choice, mathematically or counting-wise, whatever you want to call it. You either follow management guidance, you set it to 100, so the VW JV revenue, and you assume deeply negative services and other segment to get overall to a 30% gross margin, or you do as I do in this forecast, you assume a reasonable margin. I mean, 10% is a bit ambitious, but possible because Rivian is charging a little bit expensively for the services because it's expensive product and typically automakers take advantage of premium customers. But anyways, let's not go into the detail. But bottom line is this is a sensible margin assumption. But by using the sensible margin assumption for the service and other segment, we have to lower the VW JV margin assumption. Because if we don't, the margin for the overall business, combining these two subcomponents, is significantly higher than the 30% the CFO guided us for. Then there's a little other breadcrumb where, depending on how you might read it, and I put the quote down here, because the CFO said that vehicle electrical architecture and software development services paid by the Volkswagen Group are now reflected in Rivian's revenue and cost of goods sold. In the software and services segment, I just repeat, in a simplified manner, the services paid for by VW Group are now reflected in goods of a cost of goods sold. So this directly conflicts with her pure profit comment. I'm not sure if everybody gets that point. Because if it's pure profit, there cannot be cost of goods sold for the services paid for by VW Group. So by adding all these accounting effects I explained earlier and her guidance on 30% gross margin, and these comments, it implies that my modeling is probably the most probable case. On top of that, you want to look at this evidence in terms of hierarchy. The highest hierarchy is the overall gross profit guidance, which is 30%. That is hierarchically the main point, and all the other comments are hierarchically below that. And so all of this implies what you see on this slide is basically the the underlying, and her pure profit comment was maybe too much offhand. You might think now, AJ, you're really obsessed. Well, first of all, yes, that's true. But secondly, I think my logic is consistent. And the reason why I make a big fuss about it is because these details matter in terms of working out a relatively accurate forecast for the opportunity space of Rivian's profitability. So with that, we now discuss automotive, cost of revenue, cost drivers, and also for the S&S segment. So now let's discuss the margin impact. So first of all, the gross margin was 9.8% in the fourth quarter. And that's interesting in a number of ways. First of all, there was, for the first time ever, a positive gross margin. But there's a huge caveat, because the entire gross profitability, so the entire positive part, was driven by 299 million credits sales recognition in a single quarter. And this pushed it into 9.8%. That is completely not representative. So in 1Q, that's why we returned to negative gross margin, because 1Q, I expect a significant decrease in credit sales, and therefore the gross profitability goes down, with optimistically, again on all these assumptions I mentioned earlier, to see a modest gross profitability from 3Q, with a slight further improvement in 4Q based on continuing strong average selling prices and positive cost development. Also the revenue coming in from VW JV, of course. So all that adds up to a modest 2025 gross profitability, and this is precisely in line with management guidance. Management said they expect modest gross profitability for the full year, and these little details make a difference. This doesn't mean for every quarter, for the full year. So I think this is probably highly accurate in terms of how this year is going to turn out, unless there's some major currently unknown emerging. So next, you can see how gross profit margin improves quite significantly, and this is driven by, again, successful ramp of the R2 platform, and it grows through 2026, ending the year at 11.8, almost 12%, and then grows to almost 23% or above 20% in the second half of 2027. So now let's put this into context. This is a very high gross margin for an automaker these days, because global competition has ramped up quite significantly. And I think even if the US completely shields its auto market, given what's happening in the market, Rivian's still very small size. Even end of 2027, it will be still a very small automaker by automotive standards. So achieving that margin would be phenomenal. So this shows you the optimism built into this forecast. But to put this even more into perspective, maybe we should take a look at a comp. A comp is a comparable company. So what you're looking at now is the total GAAP gross margin, so the same metric we just looked at for Rivian, for Tesla. This is not a forecast, this is actually reported a gross margin, and just like in Rivian's case, this includes everything. In Tesla's case, of course, this also includes the energy generation and storage business, but we also have, and you can see this here on the left side, Tesla has also the service and other segment, which is very similar to Rivian's S&O segment. And then, of course, automotive, and in Tesla's case, automotive, Tesla usually calls it regulatory credits. It's the exact same thing as credits in Rivian's case. And then Tesla, because it's a larger operation, also breaks out automotive leasing, which is also included in Rivian's case, but it will be much smaller, and thus far apparently CFO didn't see any need to break it out. So this might come in the future, but long story short, this is very comparable. And what you can see is a number of interesting things. So in this chart, it goes back to 2022. In the beginning, you can see there was a 29.1% gross profit margin. So this is really, really high in the automotive world. And this was driven by various one-off effects that I discussed previously, so I'm not going to dive into now, years later, and was totally not sustainable. And so that margin had to come down basically, and the increasing competition, especially from Chinese automakers across various import markets, drove more intensifying competition, which drove to more margin erosion, etc. But keep in mind, Tesla is a very, very efficient automaker. Just look at the vehicles. They're very sophisticated, but Tesla tries to eliminate parts where they can, and they've done, I think, a very good job in doing so. So Tesla is, in many ways, a very, very high bar. And because the accounting in terms of gross margin is the same, we can really look at them as quite a strong proxy, and or comp, I should say. And what you can see is that assuming Rivian at a much, much smaller scale can achieve a 23% gross margin, let's just say that's a rich assumption, and let's just leave it at that. So with that little detour to Tesla, let's look again at this margin development. I think what this tells you is that the focus is very aggressive in terms of vehicle margin development. I think I can't emphasize this enough, especially given all the uncertainty in the market. So because keep in mind, this includes all the credits, etc. So if anything happens to the credits, this margin is like completely unattainable. So keep that in mind, please. So because this frames everything which we'll discuss later. So I finish here part 9 and hope to see you in part 10. Thank you for listening. Bye.